Welcome back to episode 9 of the $100 to $10,000 series, where I invest $100 every month to the S&P 500 index fund until it grows to $10,000 to show everyone that you don't need a PhD or be a millionaire to invest successfully. This week we are down 2.76% and up 4.39% overall. The week started off well with the major indexes rising and the Nasdaq hitting all-time highs. But as states reported higher COVID cases, with cases reaching over 43,000, and businesses being scared to reopen, with some companies like Apple reclosing their stores, the stock market reflected the negative sentiment. Financials dropped for the week as the Fed ordered banks to stop share buyback programs for the third quarter in 2020 after announcing its annual stress test results for 33 large US banks and US subsidiaries of foreign banks. And dividend payments for these companies in the third quarter of 2020 must not exceed an amount equal to the average of the firm's net income for the past year. Goldman Sachs and Wells Fargo saw the largest drops among the big banks, with Goldman shares falling over 8% and Wells Fargo falling 7% on Friday. And this drop could be justified because stock buybacks and dividends are a large force in bigger investor returns. But if you actually read the report, which I will leave a link in the description for you guys, it's not all bad news. The Fed considered 3 different scenarios for the current recession. The first was a rapid V-shaped recovery with a peak unemployment rate of 19.5% that would result in a negative 10% GDP change. A second U-shaped scenario where the recovery starts off slow and accelerates with a 15.6% peak unemployment rate and a negative 13.8% GDP change. And finally, a W-shaped recovery where a second COVID event begins in late 2020. The peak unemployment is expected to be 16% with a negative 12.4% GDP change. And the majority of the banks that were stress tested are projected to remain above the minimum regulatory capital requirements in all 3 of these downside scenarios. This gets a little bit tricky to understand, but bear with me. So in the report, there's this table of aggregate CET1 capital ratio, and what the CET1 ratio is, it compares a bank's capital against its assets. And the minimum requirement mentioned earlier is for banks to have a ratio of 4.5%. This standard was established after the 2008 recession because capital is necessary for banks to absorb unexpected losses in an unexpected crisis like we are seeing today and what we saw in 2008. So basically, the Fed wants the banks to have enough money on hand just in case they need it. So even in the lowest capital ratio scenario, which is the W-shaped scenario, the ratio is still above 7.7%. But the Fed is limiting the banks on its share repurchases and dividend payments just to have that factor of safety, just in case that something worse happens than expected. And there has been talks of a Phase 4 stimulus package deal. Let's take a listen on White House advisor Pierre Navarro.
I know that you have numbers and sort of a method in terms of looking at the impact of these rioters, but I want to first get your take on where we are in the economy and the potential for further stimulus. Peter, what do you want to make sure is in a potential 4th package, stimulus package? You've been the point man on manufacturing. Is that something you'd like to see in a stimulus bill, Peter?
I think where we have to start, Maria, is with a diagnosis of the problem we're trying to solve with the Phase 4. What I'm seeing is the China virus, which has foisted a pandemic on this world and wreaked havoc with our economy, has particularly hit our major metropolitan areas. If you look at the China virus kind of like as an ICBM coming in, it's basically hit the twin pillars of our major cities, which are the density, the high-rise density, and the mass transit. And if you don't have those working, then you can't have a city. So we've got that to grapple with. And then at the same time, we've also got what I call the looter math. When you have an arsonist burn down a small business, you lose 100 employees. when you have looters go in and loot a large business, that's thousands of employees affected. If you scale that up over our major metropolitan areas, we calculate that that's close to 2 million jobs impacted. So what we have is a combination of the China virus attacking our major cities, and we have this looter math coming into play. Now, what's the point here? What we're going to see as we adjust to the China virus world is we're going to see a lot of what I call service sector refugees as this economy changes from the major metropolitan areas. And so for me and for this president, one of the key thrusts of any phase 4 and any economic plan going forward has to be manufacturing jobs, a focus on buy American, hire American, make it in the USA. What we need to do as a country is to make more stuff here. What'll that do? It'll simultaneously create more manufacturing jobs, which tend to pay much higher wages, and also help the ripple effect to create a lot of those service sector jobs, which we're going to lose to dislocation as we adjust. So the phase 4, you talk about a $3 trillion program by Nancy Pelosi. You hear from Mitch McConnell, only $1 trillion. The president is very interested in something on the order of at least $2 trillion, with a bulk of that focused on bringing home our manufacturing base, starting with pharmaceuticals and medical supplies and equipment. Maria, you know that if we've learned anything from this crisis, is that we need to make our medicines here, we need to make our masks here, our ventilators and all of that. And we're doing a great job on that. We've become, in 100 days, the ventilator king of the world. And who would have thought that 3 months ago when Governor Cuomo was running around with his hair on fire saying we don't have enough ventilators? Well, guess what? Now we're exporting ventilators. So point here, Maria, is that the economic crisis we're facing, we can deal with. We have a president who, in 3.5 years, built the most beautiful economy in modern history. We can do it again, but it's going to be a different strategy than the last time. The first time, tax cuts, deregulation, cheap energy, and above all, fair trade deals. We're going to do all of that, but we've got to do more. We've got to focus on this buy American, hire American, make it here, so that all around this great country, we're going to have Americans making stuff with high technology. It's going to be not the old manufacturing economy. It's going to be the SpaceX economy.
There is some debate on whether a universal stimulus check is necessary, but according to the Center on Poverty and Social Policy at Columbia University, additional income support will be needed if high unemployment rates persist beyond July. And Albertsons, an American grocery company with over 2,200 stores across 34 states, has finally gone public, trading under ticker symbol ACI. The IPO price was set at $16 per share at 50 million shares, raising up to $800 million. And there is 479 million shares outstanding, so the company is worth about $7 billion. Albertsons owns other grocery stores like Vons, Safeway, Jewel, and Acme, to name a few. In 2017, Albertsons considered buying Whole Foods Market, which instead was purchased by Amazon in a $13 billion deal. And looking at the numbers, Albertsons reportedly had revenues of $62.5 billion, which rose 3.2% from the previous year, with an income of $466 million. And the company stated that it has been gaining market share during the pandemic, with sales rising 30% in the first 12 weeks of 2020. Although these numbers look pretty good, the company has over $8 billion in debt, and the company is owned by private firms like Cerberus, a capital management company with over 30% of common shares. So Cerberus will continue to have a majority control over decisions made by the company, which could prove to be a double-edged sword. And that's gonna do it for me this week. Please don't forget to hit the like, comment, and subscribe button with the notification bell turned on.